Hi everyone, hope you're all doing well, and today we are going to talk about DraftKings. It is my biggest position in the stock market, and as well as that, I'm sure if you're a DraftKings shareholder, you saw this news that came out yesterday. DraftKings has made a 20 billion offer for UK sports betting company Entain. So we are going to talk about this, and at first I was a bit like blown away. I was like, this is a bit of a strange move, and it took me a few hours just to kind of dig in and kind of think, what is the management team at DraftKings thinking with this offer? And obviously at first I was kind of thinking, obviously you're thinking, this company that they're buying is obviously more physical store locations or physical betting stores. And I was thinking, the management team at DraftKings are really smart guys. There must be something here to what their plan of action is, because I can't see them opening or taking over a lot of physical locations in the UK. And yeah, I've had a look. I've kind of got my theory if I think it's their plan and if it's a good plan or a bad plan. And yeah, there's a lot of things going on here. I don't think this is going to be as simple as, we want to buy you, okay, we're going to sell it to you. I think there's a lot of things that could play out here, and today I'm going to share that all with you, and hopefully the video is a little bit useful. Just before we do get on to that, if you are a patron, go check out this new exclusive video that I put up a few hours ago, which was Boohoo versus ASOS. We did a bit of number crunching to see which one was the better stock and which is the better buy. So if you are a patron, do go check that one out. But we'll get stuck on today's video, which is about DraftKings. So if we look at the DraftKings share price from yesterday, you can see, the stock reacted quite badly to this buyout. And it wasn't too long ago DraftKings was buying another company. DraftKings recently bought GNOG, but the big difference was when they bought GNOG, it's 1.5 billion. But I do think that was a really good purchase. It improved their weakest part of the company, and also the other parts they got in the deal was very good. And even the CEO, Tilman Fertitta, came on and said, DraftKings basically underpaid for this and it's a really good purchase. And yeah, I think that was really good. But the big difference is there, we were talking about a 1.5 billion purchase. The big difference from this to this purchase right now, $20 billion they have made an offer for. And I think that's what spooked the market. I think when you look at DraftKings, it's a $21 billion company itself, and people went, that's a big amount to pay out for. And I think people were just kind of like, why they're doing that, because the company they're buying isn't like a hyper growth company like a GNOG putting in 50% revenue growth. They're basically buying a company that's only growing at 10% revenue growth. And I think people were a little bit confused, and that's why the share price reacted negative to it. But hopefully I think this could work out quite well, and I'll show you why in this video. So as you can see, Entain had a big pop yesterday when the news came out that they had received an offer from DraftKings. Originally DraftKings put an offer in, and the actual market cap was, this is in pounds, was 11 billion, and the first offer was 14.6 billion, and then that was rejected. And then DraftKings have now come in with a fresh offer of 16.4 billion. So that is a 49% premium on the close on Monday, which is a bit of a big premium. 50% premium is a lot considering you bought GNOG as well, which is more of a growth company at a 50% premium as well. So yeah, when it comes to kind of like the offer itself, I have to say this is my only little concern, is if I was DraftKings, not to go more than this if it does get rejected. We'll see if it does happen or not, but that would be my only consider on the current offer that is there now. They are going to be paying this through cash and stock. So I guess the big question is, why are DraftKings considering buying Entain? So if you do go on the recent earnings, you can see here the company itself currently grows at about 10% revenue or 11% revenue growth, which isn't huge considering DraftKings grows at, I think this year could be potentially over 100% revenue growth. But the big thing is the online gaming revenue growth. This is where the growth is in this company, and there's one particular part of this company that is why DraftKings are looking to buy it. And it's this sentence here, which if you look down here, it says, BetMGM, the group's joint venture with the US MGM Resorts, continues to perform strongly. And this is the part of the company that DraftKings is after. And this is the company it's looking to disrupt. Why is that? Well, if we go on the market share of currently the US gaming growth or gambling growth, this is a massive growing sector. This is where at the moment the money is at, and there's a lot of competition going out here. Now, at the moment, there's two very close competitors for market leaders. At the moment, we've got FanDuel. FanDuel owns 29% of the market. Second of all, DraftKings. DraftKings owns or has 28% share of the market. So between FanDuel and DraftKings, it is very, very close at the moment. There's enough room for more than one of them, but obviously they both want to be the number one player. And at the moment, FanDuel, DraftKings are going neck and neck. I've always said I think DraftKings will come out on top of FanDuel. We'll see what happens, but at the moment it is neck and neck, and there's room for both of them. Let's be honest. But what comes very interesting is the smaller players. Who is the third smallest player in here? BetMGM. BetMGM, who have their joint partnership with MGM Resorts International and Entain. Very interesting. So the third player in this area is Entain, and that is what I think DraftKings are eyeing up. And then also you have your Barstool Sports and GNOG, which obviously was acquired by DraftKings. So obviously that's going to help its market share as well. But yeah, this is what I think DraftKings are staring at, is that third player in this industry. And as well as that, it's not a small amount BetMGM have. They currently have 21% of the market. So if you add that 21% of the market onto DraftKings, they well control this market, and they also very clear go ahead of FanDuel, and that is what I think DraftKings are staring at. And I think MGM know how important this is to the company and how important of a growth this is going to be in the next few years. And MGM themselves have tried to buy Entain as well. So on the 4th of January, we will see here that they actually made an offer of £8 billion in pounds for this company. So if we do go back to the actual share price, you can see here, this is the little spike here on the company where the offer was made. But they made an offer for £8 billion and it was rejected. And since then, look at the share price performance. It's up over 100%. And MGM know this is important to them, and you know they did try and buy it, and it was rejected by Entain. And if Entain was going to accept an offer, you would think it would be them, the partner with MGM, but they rejected it, and now it's gone up a lot. And MGM are probably looking now thinking we should have upped that offer. But it does show you, this company is trading at a very rich premium already. But the reason why is because people realise that partnership with MGM is really strong, and also how big the gaming sector is going to be in the next few years, or the gambling sector in the US is going to be. And that's why it's trading at such a premium. So you can see this is a very in-demand company. And that's my first point, is that even though DraftKings has made an offer, you've seen the first one got rejected. The second one is in consideration. We'll see if it goes any further. But Entain are no pushovers. They've already rejected 2 takeover offers, and the third one potentially could get rejected as well. And the thing is, well, Entain, they rejected the offer from their partners as well, and the ones that you've been thinking Entain would be more happy to take them over. So yeah, the first point is that this takeover bid isn't done at the moment. This could easily get rejected and go higher, and that's where I just want DraftKings to be careful and not get into too much of overpaying for this company. So the first part is that this is going to be a bit of a battle for the takeover, because we know Entain's no pushover. Next thing is MGM are worried, because MGM obviously have 20% of the market share, and that is what DraftKings look like they're after. And MGM have already come out and they sound worried. They sound like, we're going to make sure we still get a good end of the deal here, because they own 50-50 of the BetMGM. But they basically come out here and it said MGM will engage with Entain and DraftKings as appropriate to find a solution to exclusivity arrangements which meets all parties' objectives. So yeah, they're a little bit worried, because obviously one of their big growth sides over the next kind of few years is this. They don't want to lose that. So the thing is, you got Entain who want a good offer. You also have BetMGM, MGM Resorts, that are a little bit worried because they have a 50-50 adventure, and if they lose Entain, or if DraftKings come in here, they're a little bit worried. So they want to kind of keep that going, or don't want to get pushed out by DraftKings. And also considering MGM as well, they kind of want to own this company as well. So those are the things you've got to consider. You've got a battle for the share price here. You've got a battle for the MGM and the 50-50 partnership, and MGM as well want this company. So there's loads of things that could happen. Yeah, this is a story to watch as well. Now, if we do go through all the companies that the Entain actually do own, you'll see there's a lot. BetBoo, BetMGM, which I think is the big one that DraftKings are after, and that's why they're potentially buying it. bwin, Game Bookers, Lambrooks and Coral, which is obviously more of the UK stores. Ned, Sporting Bet, and Party Poker, and a few more down here with the classic Foxy Bingo as well. Now, going back to my early point, which I think is the big worry why why DraftKings sold off for this, and my initial reaction was, we don't want to go buy a company that is obviously 13 billion or 20 billion US dollars, already like equal the size, and then buy a company that's growing 10% growth, because then it's going to slow down the growth of DraftKings, because these guys are doing like nearly 3 billion in revenue and they're not growing fast. they're profitable, which is good, which could help DraftKings a little bit, but not a huge amount. It would be more of a impact on slowing growth, and then it won't trade as much of a higher valuation. And yeah, if we go on to like the financials here, it's not a company that historically grows a huge amount because it's tied down with its estates that it has with actual physical locations and everything like that. And also on the balance sheet, like if we go into the balance sheet, there's a lot of debt that it will have to handle as well. So yeah, overall, a lot of these other parts in the company, I don't think DraftKings, it's paying 20 billion to get one part of this company, and it's paying 20 billion to get that one part of the company to help with this. It wants higher market share. It wants to take out the third biggest market share. It wants to help overtake FanDuel. And to do that, unfortunately, sometimes what happens is you need to buy all of these brands to have that one brand. Now, what I think will happen is if DraftKings do go out and buy this company, what you'll see is with a lot of these brands here, it will do something very similar to what Caesars has done with William Hill. So if you don't know, Caesars and William Hill did a bit of a partnership, very much like how BetMGM did with Entain. Now what Caesars did, and very similar, when, this is going very well, let's actually own all of this. So Caesars bought out the whole of William Hill for 2.9 billion. Now because Caesars only wanted to have the US side of it and not any of the UK and Europe and all them retail stores, which are pretty much a dying breed really, you don't want to be owning them, is what it did, it offloaded them. And you'll see here what they did then is Caesars then actually sold its UK and Europe locations to 888, and it sold it for 2.2 billion. So this was a really good move with Caesars. They bought the US side of William Hill for 2.9 billion and then sold the rest of the pretty much the dead locations for 2.2 billion. Now just on the side note, I actually do own 888, and I was actually very angry when they did this, and I'm actually still looking at that now thinking, should I potentially sell that? Because I think buying physical stores like this is just a really bad move. But overall in general, going back to the point of the video, is that this was a very good move with Caesars. They kind of had they bought the US side of it, they control it all, and then they actually then got 2.2 billion back from that, and that worked very well. And I think that's what DraftKings is looking at very similar. They want to own that BetMGM side of this company. To do it, they have to buy it all, and then what you'll see them do is they will actually then look to spin out a few of the other parts of the company, or sell them off to kind of recoup that 20 billion pounds. So the likes of Ladbrokes and Coral, it could sell them off. It could sell them off for 3 billion or 5 billion. You get quarter of it back already, and I think that's what it will look to do. So that's what I'm thinking DraftKings are looking to plan to do now. Obviously, the guys on DraftKings, they're smart. They don't want to have a lot of these. They might want to expand to the UK and Europe, but they're not going to do it with physical locations, and that's what I'm thinking management are thinking. And I think that's why the share price reacted negatively, is because they didn't dig into that and kind of think, what are they thinking here? And that's what I'm thinking management are thinking about at the moment. That was a lot of thinking, but yeah, I think that's the plan of action so far. So overall, yeah, I think as long as they don't overpay for it, and that means probably not going any higher than what they've offered right now, it should be okay. And as long as they're doing what I think they're going to do, which is buy this brand, upset MGM, get that market share up, and then sell off a couple of the other brands, but also help with the US market share, that would be an excellent purchase. Recoup some of the money with selling some of the little brands off here that they don't want, and that would be absolutely amazing, and that's what would be a very good purchase. For me, the only little negative one, or the negative side of it, where I would actually consider, okay, that's a bad move, is if they did buy this company and then kept everything. I think they will sell parts of it off to recoup money. The only little worry I will have with this purchase is if they don't do that. But even then, like I said, there's a lot of things to still happen. You've got Entain going to take the offer. MGM obviously don't want DraftKings to own it, so they are probably going to throw the toys out the pram. Maybe they come in with an offer as well. That's going to happen as well. So you have a lot of things that might even stop this deal going through. So yeah, it's not a guaranteed, it's one to watch, but overall, if they execute it how I think they're going to execute it, it will be a very good purchase. There's still a lot of things in the way, and also hopefully they don't do what I don't want them to do, and that would be the only way this would be a negative. So yeah, it could be a very good deal. There's still a lot of things that could go wrong. So yeah, it's one to keep an eye out for sure. But if it does go the way that I think they're going to go, it could be a very good purchase in the long run in the next kind of 2 to 5 years. So hope that video was useful anyway, guys. If it was, hit the like button. If you're new, subscribe. I'll see you next one.